When will the stock market crash? Today, I'm going to help you figure it out. I'm going to explain this all to you in 3 simple, fast steps. Step number 1, we have to ask the question, will the stock market crash up or crash down? So many of you, when I say the words stock market crash, think of something like 1929, or maybe 1987, 2008, or potentially what we saw in 2020 in March. You imagine the stock market crashing down by 30, 40, 50%, or even more. But I want to point out the stock market can actually crash up. As an example, I want to pose a question to you that I put out on Twitter yesterday. Is it better for a stock investor, let's say they own the broad S&P 500, for the S&P to go down by 25% or to go up by 100%? Easy question, right? But what if I told you in scenario A, there was 0% inflation, scenario B, there was 200% consumer price inflation? Now what you have is a loss of 25% compared to a loss in your purchasing power of 33%. And let's not forget, with this loss, you have a tax deduction. With this loss, you have a tax liability, which makes it even worse. And at the end of this video, I'm going to be showing you exactly how to know if the stock market is starting to crash up or down, or maybe if the stock market has already begun to crash up. But before we get there, a lot of you at home right now are probably scratching your head and saying, yeah, George, I get what you're saying. But boy, is the stock market really in a bubble right now? Should we be worried about it crashing either up or down? To answer that question, let's go right back to my favorite source of investing information. Oh yes, that is TikTok. Editor, go to the clip.
So how do we make money from home? For starters, this is not a sponsored video. We just get this question all the time, and honestly, the answer is really simple.
So basically, I just trade stocks on an app called Robinhood, which I left a link in our bio if you want to check it out. It's free to download, free to sign up. They actually give you a free stock, so they're paying you to sign up. But again, not sponsored. And I know trading sounds intimidating. Here's my strategy in a nutshell. I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it, and I do that over and over, and it pays for our whole lifestyle. If you're wondering how much you can make doing this, in this month I turned about 400 into 14,000, and in this month I turned less than 1,000 into 20,000.
And honestly, my favorite part about this isn't even the amount of money you can make, but just the fact that we don't have to go to a 9-to-5 job.
Yeah, we can focus on things that we actually enjoy doing. So if you have friends that want to make money from home, you can tag them or send them a link. Or if you make money this way, share it in the comments so other people know there's more people doing this now.
So you see, all you have to do is just buy a stock, wait for it to go up, and when it starts going down, just sell it. I'm almost mad at myself that I didn't think about that earlier. Hello, George, why haven't you been doing that this whole time? It's so easy. I think I've been overcomplicating things. Yeah, right. Let's go to this chart. Starts in 2016 all the way to 2020. On the left, it goes from 0, up to 93,580. This is a chart of the Venezuelan stock market. And this is another example that illustrates how a stock market can crash up. So check this out. In 2013, their stock market was right around 100, so the equivalent of the Dow Jones Industrial Average. In 2015, it was up at 3,936. Now, a lot of investors, since hyperinflation hadn't kicked in yet, might not even be aware of the fact that their currency was losing purchasing power at a higher rate. They might think they're getting rich in the stock market. They might go on TikTok and tell everybody that all you have to do is buy it, watch it go up, and sell. But then we move on to 2016. Their market is at 14,588. A lot of people at this time probably scratching their head and saying, wait a minute, am I getting rich or am I getting poor because my grocery bill is skyrocketing? So now we're right about here on the chart. We get to 2017 and it starts really going up. December at 1.4 million. By March of 2018, so just 3 or 4 months later, it's at 10 million, literally off the charts. So what did the brilliant politicians do at this time? Such an easy, elegant, clever solution. Well, they said from now on, with our stock market, we're just going to divide the number by 10 million. And that'll fix all of our problems. So the stock market instantly went from 10 million all the way down to 1. But then because of hyperinflation, it started going right back up to a point in 2020 when it was 93,580. But if you adjust for the 2017 divide by 10 million, it would take their stock market from 100 in 2013 to 2020. It was right about 1 trillion. That is an example of a stock market crashing up, and something we may see to a certain degree. I'm not saying our stock market goes to 1 trillion, but understand the concept, because it's something we could see here in the United States and in other markets around the world, where the stock market is going up, but you're actually losing purchasing power because the currency that the stocks are denominated in are losing value faster than the market is going up. Step number 2, moving from a Fed put to a government put. This is a chart of the S&P 500 2020 to today, April, August, December. On the left, we go from 2,000 up to 4,000. To dive into the important dates along this timeline, let's go right to the internet. This is an article from CNBC going back to March 16th, 2020. The market was absolutely crashing down big time. The Fed came in and tried to stop the bleeding with the traditional Fed put, but this time on steroids. In an emergency move Sunday, and let's recall that they were supposed to meet on a Wednesday, but the market was tanking so badly, they came in and met the Sunday prior. The Federal Reserve announced it's dropping its benchmark interest rate to 0 and launching a new round of quantitative easing. The QE program, which later in the article they call massive, will entail $700 billion worth of asset purchases, entailing treasuries and mortgage-backed securities. And I would add they also committed to doing up to $1 trillion a day in the repo market. They did a lot of other things in addition to what this article is going over. But what was the market's response? Markets responded negatively. The Dow futures pointing to a drop of 900 points. So what the market is telling us is the Fed put has most likely expired. And that takes us to the CARES Act, or what I like to call the government put, fiscal spending, fiscal stimulus. The CARES Act was announced right around March 23rd, March 24th, and it was unanimously passed by the Senate on March 25th. And then Trump signed the law March 27th. So now you understand the timeline. Let's go right back to the chart so we can put the pieces of the puzzle together. So what happened is the Fed came in and tried to stop the carnage in the stock market by doing a massive round of quantitative easing, doing everything they could in the repo market and all these 4- and 5-letter programs. This action they took right about here. The market shrugs it off and continues to plummet. Goes all the way down to a low March 23rd, right about the time they announce and start talking about the CARES Act, going over to the government put, stimulus, government fiscal spending. So then the market sees that, it passes, it starts to go up, and from there rebounds and then goes up in a straight line almost to the point where we are today at all-time highs. I'd like to point out when we get to this level, everyone starts receiving their stimmies, the stimulus checks in the mail. They open up a Robinhood account. They see all their friends getting rich on TikTok, saying the only thing you have to do is buy a stock, watch it go up, and when it starts to go down, just sell it. That's how we can afford our lifestyle, and we don't need a 9-to-5 job. So what are all the retail investors going to do with their stimmies? They're going to buy stocks. So it continues to go up, but the market has a hiccup right here, right here. I addressed this in a past video. This is when the future stimulus or the next round of stimulus was up in the air. They didn't know what was going. The Congress was kind of in gridlock, but then finally they get through that, pass another bill, and then we're off to the races again. So what this shows us is we've most likely gone from a Fed put to a government put. So now, regardless of what the Fed does, they can take their balance sheet to infinity. Let's say a quadrillion, but realistically 10 trillion, 20 trillion. And the market could look at it, shrug it off, and continue to crash down. The government has come in and said, we're going to spend all of this money. We're going to invest in infrastructure. We are going to inject currency units directly into the real economy. So far, the market really likes it. It's gone up. So currently, there's most likely a government put. But we know what would happen if there was no put whatsoever. If we had a free market, if the government and the Fed didn't intervene, we would definitely have a crash down, a bad crash. We're talking 1929 down by 70, 80%, or at least what we saw in the GFC down by 50%. The real question we have to answer is, when is the market going to ignore the government put, just like they ignored the Fed put back in March of 2020? Because that is when we'll know the stock market is starting to crash down. And unfortunately, I think it may have just happened. More on that when we connect the dots in step number 3. Step number 3, the crack up boom. In the last step, we went over how we went from a Fed put to a government put. I want to zoom in a little more on that S&P 500 chart. So instead of it spanning the entirety of 2020, this time we're going to start off January 14th, 2021, and just go to today's date, around the 19th. On the left, we go from 3,740 up to 3,840. What happened back on January 14th? This is when Joe Biden came out and announced his new $1.9 trillion stimulus package. In other words, more money printing, more fiscal deficit spending, or what the market would see as a government put. But what happened this time? Did it go straight up like it did back in March? No, it actually went straight down. So are we starting to see the expiration of the government put like we saw the expiration of the Fed put? I don't know if I'd go that far. But what I am saying, what I think is the highest probability, is that the stock market, including the economy, is now a lot like this heroin addict. That it starts off with a little bit to achieve the high, but over the course of time, the heroin addict needs more and more and more of the drug just to stay alive, to where he's not passed out on the sidewalk like someone in downtown San Francisco, to the point where the heroin addict needs so much heroin just to achieve the same level of high. At a certain point, the amount of heroin is just too much, and it kills him. Which brings me to the next part of this chart. I kind of divided it into two. Here we go from 1 year, 2 years, 3 years. I don't really have any numbers over here because it would go exponential, very similar to the Venezuelan stock market chart we looked at in step number 1. But to understand how these two could interact in the future, the money supply and the stock market, let's go to the internet and check out the theory of the crack-up boom from Mises. The crack-up boom develops out of the same process of credit expansion and resulting distortion of the economy that occurs during the normal boom phase of the Austrian business cycle theory. In the crack-up boom, the central bank attempts to sustain the boom indefinitely without regard to consequences, such as inflation and asset price bubbles. The problem comes when the government continuously pours more and more money, injecting it into the economy to give it a short-term boost, which eventually triggers a fundamental breakdown in the economy. In their efforts to prevent any downturn in the economy, or I would argue the stock market, monetary authorities continue to expand the supply of money at an accelerated pace and avoid turning off the taps of the money supply until it's too late. Does this sound familiar? It is literally exactly what the Fed and the government is doing right now. Now let's go over to an article from Mises.org to really get our heads around how this works. The crack-up boom, as Mises pointed out, would unfold only when people came to the conclusion. Listen to this, guys. This is really, really important. I'm going to say it one more time, just to emphasize. The crack-up boom, as Mises pointed out, would unfold only when people came to the conclusion that the central bank will expand the money supply at ever greater rates. And it's not just the central bank now. It's the central bank working with the government. MMT, combining the balance sheet of the Treasury and the Federal Reserve, which is why I think Janet Yellen was hired as the Treasury Secretary. More on that in just a moment. But then finally, the masses wake up. They become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. Not just inflation of prices. What they're talking about here is an exponential increase in the inflation of the money supply. A breakdown occurs, the crack-up boom appears, or the crash up, as we're going over in our video. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. So the market starts to crash up when the general public realizes that the government and the Fed or the Treasury, whatever they're going to call it in the future when they merge the balance sheets, is going to have to create more and more currency units to have the same effect. It's diminishing returns, just like the example we used of the heroin addict. So I think it may look something like this. The money supply goes up and up and up through MMT, government stimulus, deficit spending, and the Fed monetizing the debt. But the stock market doesn't go up at nearly the same rate. In the future, we might get to a point where the market crashes down. And this could be the catalyst for the government coming in and printing exponentially more money to get the stock market to go back up. But then people realize what's going on and the gig is up. They start to exchange all their currency units for goods and hard assets. This is Gresham's law going into effect. That money supply is going exponential. Then at this point, the stock market goes exponential as well with the rate of inflation. But keep in mind, at the end, the rate of inflation will vastly exceed the rate the stock market goes up. So if we see the stock market crashing up like this, you could lose just as much purchasing power, if not more, than if the stock market were to crash down. And again, there are no certainties, only probabilities. But when I see the future, this is what I think is the most probable outcome. It starts with the government doing MMT, combining the balance sheet of the Fed and the Treasury. So these bank reserves that the Fed is now creating becomes legal tender, and they inject the cash directly into the real economy because, of course, inflation is dead. It's nothing we ever have to worry about again. Their words, not mine. And I want to point out, I'm not the only one that's talking about MMT and this exact process. Editor, let's cut to a clip of one of my favorites, Jim Rickards.
Modern monetary theory is now the law of the land, if you want to think of it that way. So we saw we have $1 trillion per year baseline budget deficit. That was going into the pandemic, before the pandemic even came along. So Trump got us back to $1 trillion, kind of where Obama left off in 2011, I think was the last $1 trillion deficit. So you have $1 trillion baseline deficit. The Congress put $3 trillion on top of that in March and April and May through the CARES Act and a couple other acts. So now you're up to $4 trillion for fiscal 2020. Now we're in fiscal 2021. We just had $1 trillion, about $900 billion that got done in the last days of the Trump administration. But now Biden's going to come in and do, they think, $2 trillion on top of that. So I mean, we're talking $6 trillion on top of a $2 trillion baseline budget deficit, $8 trillion of new debt in a $22 trillion economy. Our debt to GDP ratio it is already, I haven't computed it lately, but it's at 130. He's going to push 135% by the time they're done. Who's in that league? Well, I can tell you, it's Lebanon, Greece, and Italy. You know, that's your lunch table, your four-person lunch table. So that's the club the United States is now in. Modern monetary theory says, don't worry, because it's all in dollars and we print dollars, so we can never run out of money. Therefore, we can never go broke. I think that's literally true.
It is.
But it doesn't mean that people want the dollars.
And it doesn't mean that it works.
It doesn't mean that it works. It does. And here's the bottom line, just kind of putting an end to MMT. There's no legal boundary. That's true. There's no accounting boundary. That's true. But there's a confidence boundary. It's invisible, hard to know. You don't know you hit it until you hit it, and then things collapse. People forget 1977, the United States issued treasury bonds, treasury notes denominated in Swiss francs. They were called the Carter bonds, but they were denominated in Swiss francs. People said, we'll take your credit, but we don't want the dollars. And so we did, and we issued Swiss franc denominated treasury notes. That's how bad it was in the late 70s. It seems like the ice age to people today, but I remember it, and we could get back there very quickly. But yeah, I think it's important for investors and asset allocators to understand that MMT is not a novelty. It's not a fringe theory. It's going to be the primary economic policy of the Biden administration. Stephanie Kelton's working behind the scenes. Janet Yellen's the front person. Who better? Because she can merge the Treasury and the Fed. Powell's going to do what he's told. So will the big banks. And here it comes. So get ready.
So the government starts spending money directly into the real economy through MMT. No need to sell bonds. No need to increase taxes. We never have to worry about how we're going to pay for the Green New Deal, for stimulus checks, healthcare for all, education. Because we have the dollar, we never have to worry about how we're going to pay for anything ever again, according to Stephanie Kelton. Then the market goes up slightly, but then we have this market crash that I talked about here. The money printing goes exponential. We can kind of see this going on right now. Editor, let's throw up a chart of M2 money supply. We can see the rate of growth in 2020 compared to what it was doing in the past. It looks like it very well could be the start of an exponential growth curve in the money supply. And what ends up happening, just like the example of the heroin addict, is the Fed and the government print so much money that at a certain point, it kills the economy. So when will the stock market crash? I think it'll crash down when the government put finally expires. They continue to print more and more money, but the market doesn't care. It goes down in nominal terms. And the market will crash up when, according to Mises, the general public realizes that the government, the central planners, will have to create more and more currency units at an exponential rate. That's when the gig's up. And I personally think the crash down could be the catalyst to the crash up. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.